So the next confluence that we're going to go through is an order block. And these are very simple, as are most of the confluences that I use. In short, and a simple explanation is they are the move that causes the liquidity sweep. So when you see a sweep, price comes down. For example, our price in this case, price goes up here, takes out this liquidity. It's the move up that causes that. So you can see the move up here is all of them blue candles, which are green candles. I just changed the colour. So this is the order block within here. So it's just a move up that causes a liquidity sweep. And it's important to understand why these occur. And price can come back up to an order block as big banks and institutions know they can fill more orders like they have done previously. So coming back to this example here, so let's make that black, my order book's colour black. We can see that a lot of sell orders will be able to fill up at this price here. At this price here, lots of orders able to be filled, as we can see. So then price would come back up into this area where sell orders can be filled, and then we execute more sell orders. So it's a really good tool to use for retraces, and to use if you miss an entry on a liquidity sweep, or if, like me, you look for a 5-minute retrace before entering. It's good. We can get a 5-minute retrace into an order block and then see rejections and take a trade. So I've got some, and they can be used on different time frames. For example, you could have a 15-minute order block. You can see it get hit on the 1 minute. You scale down at the 1 minute, you find a breaker structure, you can find entries that way. So I've got some non-chart examples here. So this is an example of a bullish order block. You can see prices chop is going to the upside. We get a liquidity sweep. We push past this area of liquidity here. Push past this area of liquidity here. And then then we take the move up that causes a liquidity sweep, which you can see is from here to here, which creates the order block, and then price usually would come down with the sweep. It'd have a retrace back into the order block, and then we see bigger rejections down. Usually I find my entry to be better off order block or a fair value gap, a retracement tool, because I find we get a bigger dick to the downside or to the upside, but we also get a better entry as we have more confidence. Whereas if we just took it off the liquidity sweep, price could just come reverse and stop us out. And it's also not a guarantee that price is going to flood all the way down without already retracing. You can kind of get a better entry and a better price. So that's a bullish order block, and then we'll look on the bearish side of things. So this is a reversal. So we've got a liquidity sweep here. Obviously, we take the leg down that caused a liquidity sweep, the move down, which is from here to here. This is our order block. Our sweep causes price to go up. We get a little bit of a retrace naturally into the order block so that banks can fill more orders, and then we get a rip out of it. And that takes us high to the upside with a lot more upside potential. So how does this look on the markets? As in, I've already drew one example there with a bit of an order block. And like I said, any time frame. Sorry, I've got a bad call. As you can see, it's took from the move up. So the reason that it's the move up. So we can see here, we have our sweep. Here we take out liquidity, we come up, take out liquidity, and then we're looking at the move up before, which is the start of these blue candles. Obviously my blue candles, and my green candles, my black, and my red candles. So it's on, because it's a bullish order block and we're going to the downside, it's always going to be the move up, which is the blue candles. So any blue candles that have caused a liquidity sweep, we can see 1, 2, 3, 4, 5, 6, these 6 candles here. We take from the bottom wick of that candle to the top wick of this one, and then we can see price comes down. See, many people would enter here at this point. Maybe after a breaker structure here, you enter, you put your entrance here, you put your stops at the breaker structure, and then your target here. The problem with that is you're going to get stopped out when the retrace is coming to the order block, which is why I prefer to delay my entry until I get a retrace into the form of an order block, equilibrium, or a fair value gap, even a breaker block. We'll come into that a bit later. You can see we come up here. Obviously, we come up, sweep liquidity to the downside, and then we're looking that we have a retrace here, and then we get rejections off this order block, and then you can see we have a much, much, much bigger move to the downside. If you're going to play off just the order block here, we can see we get an order block fill. You see we come up and we also fill this fair value gap, which I covered in that last video. We fill an order block, we fill a fair value gap. You're looking for a rejection off that, you enter here, stops above either the order block or the fair value gap, whatever you prefer, and then we're looking to the downside, and we have all of this downside potential just because we waited for a retrace into more confluence. We waited for a fair value gap and an order block both tying together. what I find with how I trade is a lot of the time they will tie in together, and you can use them hand in hand, and they work really well together. So that is one example of a really good trade that you can take. We'll move to a different timetable time frame, maybe the 4, and look for a trade on this. Here, perfect. You can see we have a high here. We sweep out this high. What is the move up? It's the move up the bottom of this candle to the top of this candle. We obviously then draw our order block. That is the order block. You guys should understand it by now why it's the order block, because it is the move up here that causes a liquidity sweep. This is the high, and then we push up past the high. So these two candles are the move that cause a liquidity sweep. So therefore, it is our order block. You can see also we create a little fair value gap within here. Again, what did I say? They work hand in hand, they work together. It's just an extra added layer of confidence for you to take. We sweep out this liquidity. Okay, so we have an order block form. We also have this bearish imbalance. You can see price comes back, retraces into not only the fair value gap, but also wicks the order block. And then we have rejections out of that. And you can put to the downside here after this rejection. Stops above fair value gap, or if you want to risk on, you go above the order block. Either or the fair value gap, and you get a really good risk to reward ratio on that trade. So in essence, it's just another confidence to use, another little building block that we can use. My homework for you guys would be to try and find maybe say 5 order blocks, but on 3 different time frames. So find 5 order blocks in the 4 hour, maybe then go to the 1 hour, go to the 15 minute, go to the 5 minute, go to the 1 minute, whatever. Find 5 of the blocks, but also try and tie them into your other confluences of your liquidity sweeps, your breaker structures, and the fair value gaps. And then you should be good, boys, because then we're starting to, add a lot of confluences to what we've already learned. And this is when it starts to get exciting. This is when it starts to understand trading a bit more, start to understand when you can enter, when you can exit. And yeah, it just gets a lot more exciting from here. So thanks for watching, and I hope it helped. Any questions, just leave it in the comments and I'll make sure to answer. Thanks for watching, guys.